Hey everyone, welcome. So today we are diving headfirst into a real nail-biter, Micron's latest earnings report. Honestly, it's absolutely baffling. The numbers are telling two completely different stories, and our job is to figure out which one is the truth.
So first up, the headline that should have sent the stock to the moon. Micron reported a 196% year-over-year revenue growth. Let that sink in. This wasn't just a good quarter, this was an absolute blowout, a monster number, all fueled by the AI boom. But this is what actually happened. After hours, the stock didn't just fail to go up, it tanked. It fell 7%. You have record-breaking revenue, and the market turns around and punishes you for it. How on earth is that possible? Well, this right here, this is what we're calling the Micron Paradox. It's a classic Wall Street showdown, you know? You've got incredible performance on one side and some kind of deep-seated fear on the other. And it brings up a huge question that we have to answer. So look, the whole point of this is to understand this disconnect. You've got record revenue plus 196% and this sharp negative reaction, minus 7%. Today, we're going to tear this thing apart using the same kind of thinking an institutional investor would use to make a decision. And that leads us to the multi-billion-dollar question. Is the market's panic just short-term noise? Something that the smart money should probably just ignore and maybe even buy into? Or is it a signal, a real warning that this incredible AI growth cycle might be hitting a ceiling? Okay, first, let's play the part of the bull. Let's look at the overwhelmingly positive case here. The argument is pretty simple. This company is sitting at the heart of the biggest tech revolution of our lifetime. And the numbers, well, the numbers don't lie. And what's really interesting here is that Micron didn't just meet the super high expectations, they completely shattered them. Wall Street was hoping for about $22.5 billion. Micron comes in and drops nearly $24 billion on the table. For the bulls, this is Exhibit A. It proves the demand is even crazier than anyone predicted. And this slide right here, this shows you why that demand is so intense. Their most important product for AI, the high bandwidth memory chips that companies like NVIDIA are desperate for, is completely sold out. Not for next quarter. It's sold out for the next 2, almost 3 years. That's not a guess, that's a fact. So, if we're going to sum up the bull thesis, it's this. You have a company firing on all cylinders, sitting at the absolute center of a generational technology shift, and its demand is locked in for years to come. From that point of view, a 7% drop looks totally insane. A massive overreaction. Okay, let's hit the brakes and switch gears. Let's put on the bear hat for a minute. Why in the world did the market sell off so hard? Well, it all comes down to one number that completely spooked investors. $12 billion. This was the red flag. Micron announced this massive, way higher than expected increase in something called Capital Expenditures for the year. And let me tell you, in the world of investing, huge, unexpected spending sprees can be terrifying. So what is Capex exactly? Well, think of it as the money a company spends on huge physical projects. In this case, it's for building these enormous new factories. They call them Mega-fabs, to produce all those AI chips that are sold out. Basically, you're spending a ton of money today, hoping to make even more money tomorrow. And right here, this is the absolute core of the bear's argument. They're asking, is this spending a slam dunk guarantee of future profits, or is it a giant, incredibly expensive gamble? This spending is going to crush their profits in the short term. And what if the AI demand slows down by the time these multi-billion-dollar factories are finally built? That is the risk that sent the stock tumbling. So wow, we have a really powerful bull case and a pretty convincing bear case. How do we decide which one is more likely to be true? Well, we don't guess. We use a framework for thinking and probabilities. It's called Bayesian analysis. It's just a logical, step-by-step way to update what we believe when we get new, and in this case, very conflicting information. The process itself is really simple, but it's powerful. First, we have to establish our prior belief. Basically, what did we think before this report came out? Second, we weigh the new evidence, all of it, the good and the bad. And then finally, we update our initial belief to form a new, more informed posterior belief. So let's start with that prior belief. Before this earnings report, the market was overwhelmingly bullish on Micron. The stock was trading near its all-time highs. we can kind of put a number on that sentiment. Let's say there was roughly an 85% probability that the bullish story was the right one.
All right, now we get to the fun part. We weigh the new evidence. In the bulls corner, we have that historic 196% growth, the massive earnings beat, and the fact that their most important product is sold out for years. That is hard, factual data. In the bears corner, you have the huge Capex number, the market's negative reaction, and this more fuzzy question about long-term sustainability.
So after weighing all of that evidence, we have to update our initial 85% bullish belief, right? We have to factor in that negative Capex signal, but without totally ignoring the incredibly strong revenue signal. And this gives us our final data-driven probability, the posterior belief. And here's our verdict. Our analysis shows that the hard evidence, the sold-out capacity, the insane revenue growth, it just significantly outweighs the fear about future spending. So the probability that the STIP is just noise stays really high, at 75%. Let's just state this as clearly as possible. Based on the actual evidence in this report, there's a 75% probability that the market's 7% drop was an overreaction, just noise. And that means there's only about a 25% probability that this is a true signal that the AI party is over. The underlying strength just seems way too significant to ignore. But at the end of the day, this framework is just a tool for critical thinking. The data is all on the table, the bull and bear cases are crystal clear, and we've run the numbers. So the final question, that's for you. Based on this evidence, how are you adjusting your probability matrix? Thanks for tuning in.